we said at the start of the program, Australia's economy has proved incredibly resilient to interest rate rises. Unemployment is now lower, giving people a chance to survive the higher costs. Even our housing markets have held up, and now 2 years since rates started to rise, most remain close to all-time highs. Well, Eleanor Creagh is a senior economist with REA Group and joins me now. Eleanor, this robustness is astonishing, but it goes all the way back to employment, there's no doubt.
Yeah, I mean, it's quite remarkable to see some of the price rises that we've seen around the country 2 years on following what has been the most significant tightening cycle in a generation, or really on record. With that substantial tightening, borrowing capacities have been reduced by maximum borrowing capacity is reduced by around 30%. So many people thought the falls that we saw in 2022 would not only be deeper, but extend far longer. We've seen that quite the opposite has occurred. If we take Perth, for example, prices up almost 30%. And as you say, resilient labour market conditions really playing into that resilience in the property market as well, fueling not only that stronger home buying demand environment, but also keeping prices resistant on the downsides from that forced sale environment that could have come to fruition if the unemployment rate had moved a lot higher.
So it wasn't just the employment numbers that came out this week that were important, but also population numbers. Australia's population is now 27 million, and I did the stats, and it's 1.3 million people more than in March 2020 when the pandemic began. So in other words, we think about this, about 4 years, Australia's population has added 1.3 million people. But at the same time, the number of people unemployed in that period has dropped by more than 100,000 people. So unemployment down by 100,000, population up by 1.3 million. And that largely has not only driven our economy, but our housing markets as well.
Yeah, exactly. I'm really speaking to the resilience of labour market and also the housing market. We know that having a job is really fundamental as to whether you could continue to pay your mortgage. We know that for a lot of people that were transitioning off those record low fixed rates and onto higher variable rates, certainly the job security and the safety net that the strength in labour market conditions has provided really allowed us to avoid that forced sale or fixed cliff environment that many were speaking about in 2022 and 2023. Since then, we've seen that housing market conditions have remained incredibly buoyant. Those strong population growth numbers, certainly part of it as well, against the backdrop of a chronic housing shortage that's been exacerbated by construction constraints.
Because there's little doubt in my mind that had Australia not had that very sharp population increase, or indeed had the housing market not stayed as resilient as it has, that Australia would right now be experiencing a very deep recession. And it's not.
Yeah, that's exactly right. So thanks largely to strong population growth. We know when we look at the GDP figures that we've seen 5 consecutive quarters of negative per capita GDP growth. So really, the situation would be very different, I think, if we hadn't had that strong population growth. Again, in the housing market, strong population growth has fueled both tighter rental market conditions and the ongoing surge in rental prices, but also stronger home buying demand. And certainly speaks to the fact that it is this profound supply-demand imbalance that we're seeing that is offsetting or outweighing the downward effects of interest rates, and really speaking to the fact that there are many determinants of home prices outside of interest rates, with supply demand really at the forefront of the drivers of the housing market at the moment.
And if government were out to fix anything right now, it would be to fix the problems that are endemic inside the construction industry. Construction industry is not building, developers are not building because there is no profit incentive for them to do so. Land is expensive, it takes time, interest rates are higher, profit margin squeezed.
Yeah, look, it's quite literally and figuratively harder to get projects off the ground at the moment. We know materials costs have surged around 30%. We've got labour shortages. At the same time, we've got higher financing costs. So a lot of projects that have previously been approved simply won't commence because the internal rate of return just isn't there to make them feasible for developers. So certainly until we ease some of those constraints that are hindering the commencement and completion of new homes, it's going to be very hard to lift building activity to where it needs to be, given how much our population has grown.
And oddly, one of those things that needs to break is interest rates. A cut in interest rates would be the first immediate relief on some of those developers.
Yeah, I mean, certainly interest rates moving lower is going to help with lower financing costs as well. Continued price rises in the established market are going to provide better pricing conditions for developers too. So that's probably going to be an incentive over the next kind of 12 to 18 months to see new supply coming online. But none of this is a quick fix, and it's going to take time.
I'll tell you what, Eleanor, Creagh, always great to chat to you about these things. Many thanks for your time.
Thank you for having me.